Aloha, hey, it's Julie Ziemelis, 365 Hawaii, and I am with Real Broker. And today I am with Travis Green from Guild Mortgage. And this is kind of like a little treat. Travis usually joins us for our island wide update for real estate and then mortgage. But I brought Travis in because we've got things going on after the election. And I wanted to talk to him about that. And also, people are starting to think maybe it's time to buy a house. So I wanted to have Travis tell you a little bit about the mortgage rates and also maybe some dynamics that are affecting that. Travis, what do you have to tell people about what's happening in the mortgage industry?
Thanks, Julie. So, well, mortgage rates are, let's just get to the point. They're about 7% on average for a 30-year fixed right now.
Okay,
If
which is
you'll,
actually up.
it's up. Yeah. So if you'll recall, back in early September, late August, we were trending down towards 6%. Some people were getting interest rates that started with a 5. And ever since mid-September, they've climbed. And a number of things have happened. Obviously, what's today? November 13th,
Yeah,
14th, November 14th.
14th.
So a lot has happened since September. And one big thing that has happened is the Federal Reserve has cut their benchmark rate twice.
Right.
So they did that first rate cuts in September, and it was a half a point cut. And then they just did another one.
The
It was
day after the election.
2 days out, yeah,
Yeah.
because normally they're Tuesday, Wednesday, and then the election week they did Wednesday, Thursday, but they did another quarter point rate cut, and so that's a substantial amount of rate cutting, and so short term rates have gone down, and the stock market has liked it, but
The stock market likes it a lot.
well, there's some other things going on that the stock market
Okay.
likes too, but mortgage rates are not, you know, not participating in that celebration, right?
Oh,
They're
yeah.
not
Okay.
they're not partying,
Yeah.
and so they've gone from an average in early September of like 6.125 ish, 6.1,
Hmm.
up to just over 7% now. So in a 2 month span, we've got almost a full percentage increase in the average 30-year fixed rate for most consumers.
Right. And now get this. Most people don't understand this because for like a long time, you guys, when I used to like talk about, mortgages, they say, well, the Fed is at whatever. And then we go, oh, good. When the Fed does something, it immediately affects the mortgage rates. And every time I talk to a mortgage professor, they're like, oh, not so, Popo.
Yeah,
They go, you
yeah.
know what? It has this different thing with the yield and spread and all that good stuff.
We push up our glasses and go, well, technically,
Right,
we get
right.
very,
That doesn't really
we get
happen
very
that
precious
way.
about it.
Well, it's
Yes.
weird because usually it does seem to like, and it does. And then usually a mortgage person will then say, well, it tracks, la, 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 right? This seems like it's going in polar opposites.
It does seem like they're moving in opposite directions a little bit. And so, do you want to get into why that happened from September till now?
Sure, for all you wonks, let's hear it.
Okay. So, a couple of things. So, September rates started going up. And that also corresponded with the prediction market odds increasing of a Trump victory in the election.
Okay.
And so with that happening, along with just the general like volatility of an unknown outcome of an election, but when prediction markets started thinking that it was likelier that Donald Trump was going to win, the bond market reacted and started sending rates higher.
Okay.
Okay. The reason for this, number of things, but the bond market looked at the policy, the bond market's just looking at the policies of both candidates and evaluating, okay, what if implemented, what impacts would these have on the
Long term
on the
effect
long
of,
term,
yeah.
yeah, the things that we care about, inflation and growth and stuff like that. And so with the likelihood of a Trump presidency increasing, the likelier his policies are going to get implemented. And so the bond market's looking and saying, okay, number one, the 2017 tax cuts, big income tax cuts, are almost certainly going to be extended if he wins. And now that there's a Republican White House, Senate, and House of Representatives, foregone conclusion, those will be extended. The thing about that is
I'm
that
trying not to have a face here.
the thing
Go
about
on.
that, the reason that the bond market cares about that in a different direction than the stock market is because it it is expected to add to the national debt. It did after implementation. It will probably continue to do so. The argument against that is that it'll spur so much growth that even at lower tax rates will fill in the hole. That's not what has happened in the past. So the bond market thinks, okay, well, we're going to add to the national debt. There has been evidence in the last, I mean, there's really clear evidence, I think, in the last year or so that the bond market cares about the national debt.
It should.
It's around $36 trillion
Yeah.
right now.
Yeah.
It's a lot.
We should all care about that,
We should care
actually.
about it. We all do in the abstract, but so the adding to the national debt is a concern, right? The reason it's a concern is because for the debt to grow beyond what we can service every year, the government has to issue more bonds, right? And so issuing more bonds means that existing bonds are
Lose
not
value?
Yeah, and so that pushes rates up, right? So it's like you pump a bunch of money into the
Right.
system,
And it devalues a dollar.
exactly.
Okay.
So same thing with bonds.
Okay.
And so there's that concern. The other two main concerns are tariffs. So if tariffs are imposed on all imports across the board, especially coming into the holiday shopping season, well, it won't happen, I guess, until January at the earliest. But tariffs,
That's called doom spending. Go on.
so tariffs being imposed, that could be directly inflationary, right? Because the end purchaser is going to be the person who pays it, right?
Right.
So if you sell a T-shirt for $12 and you get it from your supplier overseas for $10, you sell it for $12. If the supplier raises their cost to $12, you're not going to sell your T-shirt for $12 anymore. You're going to raise it to at least 14, right? So that's how the bond market expects tariffs to play out. And the other thing is the planned mass deportation of immigrants. And so
I'm not having a face here. Go on.
the thing about that is that
That's going to ruin the people who work on the bottom rung of society doing low paid jobs.
yes, yeah. So beyond it just being like very expensive to like capture, detain, and remove all those people from our country, just that is expensive. The removing that labor force, which is paid less than the average, less than an American citizen on average is, but also contributes billions of dollars a year to income tax, Social Security, Medicare. Removing that from the system would not be good for the economy. Could be inflationary, right? So think about your produce getting more expensive,
Right.
again,
Right.
right? So
As it rots in the field.
right, yeah.
Okay.
So those things are, I think, weighing on, or influencing what's happening. Stock market loves lower taxes and less regulation, so
It goes up.
Yeah, new records set in the Dow Jones, the S&P, and the Nasdaq, but lower taxes, less regulation. Bond market's concerned that it's just going to add to the national debt, possibly be inflationary, so interest rates go up. So that's kind of what has happened.
That's so pleasant.
Yeah, I love coming here and sharing good news.
One of these days, Travis is going to sit here and say, we hit 5%.
I will say, I feel like a huge necessary caveat is that nothing shocks me anymore. I'm surprised but never shocked. And but I feel like the market can rationalize almost anything.
Yeah.
So, we might get into, who knows, we might get into the future and the bond market's like, yeah, we don't care about the national debt anymore. I know. I'm just saying it's not like, it's not like a black and white, hard and fast, like if this, then this. This is just where the sentiment of the bond market is influencing rates right at this moment.
There you go. Well, it's funny because my daughter, okay, let's check. My daughter is just like your average schmo, if American, right? She's like, oh, Mom, schmo. I'm doom spending. I'm pre-buying everything I normally get from China now, just in case. Like, yeah, this is doom spending, that kind of attitude. And she's like, I've gotten some princess dresses. I've got party things, blah, blah, blah. It's going to show maybe that there was some kind of crazy uptick in the economy over the last quarter of 2024 if everyone's out there trying to pre-buy things from 2025.
Kind of like Cottonelle at the beginning of the pandemic. Kind of, I don't know.
Well, and also,
That'd be interesting to see.
We're going to bring Lance Owens in on the conversation next, and we're going to talk a little bit about that Cottonelle experience with housing. But thanks for letting us know at least this part of the market. So it's 7% right now.
Yep.
Okay, and then you guys stay tuned, and when you come, and we're going to talk about what the future looks like when Lance joins us. So thank you, and we'll give you part two in a few minutes.